Welcome to Wall Street versus Main Street, a different take on the investment show with our host, Dax White. Dax White is the managing partner of the White Law Group, a national securities fraud, securities arbitration, and investor protection law firm with offices in Chicago, Illinois, and Vero Beach, Florida. The White Law Group has represented hundreds of investors in FINRA arbitration claims against their brokerage firms, and throughout this show, Mr. White will shine a light on some of the tricks of the brokerage industry, while also providing valuable information for investors on how to successfully navigate the investor-financial advisor relationship.
Welcome, everyone. You're listening to Wall Street versus Main Street. I'm your host, Dax White. As the lead indicated, this is a different take on the investment show. The objective here is not to provide investment advice. I'm not licensed to do so. Rather, I am a securities attorney who represents investors in claims against brokerage firms. And over the course of my career, I've picked up a bunch of things and gleaned a bunch of things from that practice that I think would be helpful to investors out there as you navigate that relationship with your financial advisor to hopefully make it a more productive one, arm you with good questions to ask them, give you some examples of things we've seen in our practice so that you can help yourself to avoid being a victim of a securities fraud in the future. So that's the plan. Each week we'll tackle different topics, pass along things that I'm seeing in my practice. And this week, the one we're going to focus on is a newer investment that's out there called a business development company, or BDC. And what a BDC is, for those of you who've never heard of one, which is probably the vast majority of you, because this is a relatively new investment that is primarily being sold by smaller independent brokerage firms. So if you're out there with a Morgan Stanley account or a Merrill Lynch account, you're probably not being pitched this. But what a BDC is a form of an investment company that invests in small and mid-sized businesses. And it allows investors to buy shares in the BDC, and the money from their investment is then used to fund the business. And the reason that it's becoming popular is because there's an income component to the investment because of the way it's structured, similar to an investment trust. A BDC is generally not subject to federal corporate income tax as long as the BDC pays out 90% or more of the profits to the investors. So what that creates is a product that is generally sold as follows, at least in my experience. They'll tell you that they've got companies who sponsor and sell the BDCs, and give you the opportunity to sort of get into the world of venture capital in a way that a Main Street investor never ordinarily would have been able to do. And so basically it's your opportunity to invest in small companies, but to do so sort of in a mutual fund capacity as opposed to a direct investment with one small company. A BDC will pitch it as, this is your opportunity to invest in a number of small companies that we've vetted to make sure that you're getting good investments. And the other thing that they're usually selling you on is that income component, where they'll talk about how, because of the way it's structured, they've got to pay out 90% of their income in distributions every year. So it appeals typically to investors who are either retired or focused on income for whatever. Maybe you're disabled and you need income from your investments, or maybe you're just a really conservative investor who's focused on income as opposed to growth. And so that is who it would generally appeal to, is because it's got to pay out 90% as income every year. And so it can't be like some equity companies that don't pay dividends. They're reinvesting in their business and growing it that way, and there's a compounding factor there. But for an income producing investor, they don't care about that because they'd have to sell part of the investment to create income for themselves. This is the opposite. This is something that has to pay out income every single year. It can't keep money in the business. And so it would appeal to that type of, again, retired investor who's seeking income. And so that's sort of the pitch, is they focus on, hey, this is a venture capital play, allowing you to get into an investment structure. It's considered an alternative investment. So this would be an alternative to some of your other investments, a further diversification tool. You've got your equities, you've got your mutual funds, you've got your bonds. Let's do these BDCs as a way of getting you an alternate investment And the way it's structured is it's allowing, smaller investments, Main Street investors to get into something that otherwise was confined to just huge institutional venture capital funds. And it'll provide that income you're looking for. And oftentimes right now, these BDCs are paying upwards of 8%, which in a very low yield environment can be super attractive. The problem that I envision, and the reason we're talking about it today, is because the reason or the way they're getting you that 8% return is with an enormous amount of risk. Not all these BDCs are created equal, and you have to sort of understand both the correlation between risk and return and the fundraising component of raising capital like this. The risk return component it should be relatively obvious. There is a direct correlation between risk and return. And so the higher the return, the more risk you're taking on. So if you're getting an 8% income from your BDC in a market where treasuries are paying 1.7%, that means you're getting 4 times more than you would by putting it in something super safe like U.S. treasuries. And in order to get you that kind of yield, you're taking on an enormous amount of risk. The reality is companies, when they are borrowing money like in bonds, they obviously would rather borrow the money cheaply. So if you're Ford Motors, your bonds might only have to pay 3% to entice the market to buy them. Whereas if you're a small new company who's looking to raise money, you're going to have to pay the market more to induce people to buy your bonds. These aren't bonds, but similarly, the way that they entice people to buy them is by offering a high rate of return. If they were safer investments, they wouldn't have to offer that return to you. So when you see 8%, you have to know that these are generally higher risk investments. And actually, the private placement memorandums for these investments will bear that out. Financial advisors will often gloss over the risks and tell you, oh, my company's done the due diligence. This is a great offering. But if you actually read the materials, it's going to be in there. All the disclosures, all the risks are going to tell you that, this is a high risk investment. And maybe you're okay with that because you want the 8% yield, but you got to understand what that comes with, which is the downside that you could lose a good chunk of your money, by investing in this. So that's the first concern that I would have is that in this market where we've got a lot of retired investors who, retired based on that golden rule that used to exist, that you could safely get 4% on your money, and it doesn't exist anymore, and you can thank the Fed for that. But by keeping bank interest rates as low as they are, you can't get any money in a savings account. You can barely get any money in CDs. You can get that 1.7% in treasuries. But the point is, you can't get 4% without risk. And so what we have is the people who invest, let's say you've retired with $1 million portfolio, hoping to generate $40,000 a year of income that on top of your Social Security, you'd be in pretty good shape. The problem now is if you say that to your financial advisor, he's not going to be able to do that strictly with municipal bonds and treasuries and AAA rated corporate bonds. He's going to have to include some higher risk stuff to offset the fact that a lot of your money might only get 2-3%. And so again, that's the concern with these BDCs, is that they might be being sold by financial advisors that are underplaying the risk because they're trying to hit their mark and get you that income that you need while you're retired. BDCs are actually very high risk. Don't let them gloss over those risks. Make sure you understand them and make sure that you're willing to accept them. So that, again, that's the first concern that I have is just the risk return component there when you're getting an 8% return. The other thing that I think is important to understand, and this is more macro understanding, but you have to understand fundraising. And again, it goes back to, they don't want to pay you 8%. They want to pay you lower, but they have to pay you 8% to get you to buy it. And so you have to understand when you're getting that kind of return, or when you're buying a BDC of some, a basket of smaller companies, you have to understand that those companies would rather have gotten a $10 million investment from an institutional investor as opposed to $1,025 or $25,000 investments from a bunch of retail investors. So the problem here is that they went to the institutional investors and they couldn't sell it because those people are super sophisticated and they don't want it. They look at it and go, no, you're a new company. There's a lot of risk there. We don't want to buy your debt. We don't want to provide you with equity because we're not sure that you're going to make it. And so they start with the institutional investors. That doesn't work. Then they go to the bigger banks on Wall Street, like your Morgan Stanleys, like your Goldman Sachs, and they can't sell it there. And then they end up at your independent broker dealers who are looking at the commissions going, sure, we'll sell it. But now we're further down the totem pole, and you're ending up in many cases with products that don't have the same, grade A institutional, bar in terms of, how the quality of the investment. So keep that in mind when you're being offered a product as the next great thing. If it was so great, they wouldn't need to be selling it in $25,000 increments. They'd be selling it in huge baskets to large institutional investors. That's the other concern, is that some of these BDCs are not going to be good quality. They're going to go bad. Some of them may be great. Sometimes there's a market component to these things where, a rising tide lifts all boats. So if the market's humming along, some of these BDCs might do great. But what we've seen historically is when the market goes bad, it flushes out bad investments. And my concern is that some of these BDCs are probably going to fall into that category. And part of that concern is both in terms of the quality of the companies that you're getting here. You're basically buying into, smaller companies, and you're getting a bunch of them. And so you might have some poor quality amongst, the basket of investments you're getting. But the other concern I have just has to go to the structure of the investment. There are a ton of similarities with the structure of BDCs to a product that we've seen over the last 6 or 7 years of our practice in a number of our cases, and that investment's called a non-traded REIT, a non-traded real estate investment trust. And the similarities have to do with just the cost component. Both investments pay enormous commissions to the financial advisor, upwards of 7%. Both of them pay, upwards of 3% due diligence to the brokerage firm who's selling it. So you've got a cost structure of upwards of 10%. They're both illiquid. They both have virtually no market to sell them unless they go public, which in a lot of cases doesn't happen. And so because of that, you've got, the problem, again, going back to the non-traded REIT example, in our experience, if you've got an investment who's supposed to be paying 7%, but on your $100,000 investment, they really only bought $90,000 of real estate because they had to pay out the financial advisor and the brokerage firm. In order to get you that 7%, they've got to be really aggressive. It's got to be a high-risk investment, because instead of having to make 7%, really what they have to make is 17%. And so what happens in that context is that usually it requires a lot of borrowing. And then in the real estate investment trust category, those non-traded REITs, when the real estate market moved against them, it blew out the little equity they actually had in those real estate products, and it hammered the investment. We've had, like I said, a number of non-traded REIT cases over the last 7 years or so. And that's been sort of the progression, is that they sold it based on the income, similar to BDCs. They sold it as relatively low risk, similar to what I've seen with BDCs. And as soon as the real estate market moved against them, a lot of them got blown out, huge losses, 50, 60, 70% losses. And so, it's because of the way the investments are structured, because of the huge cost component. And again, the reason it's structured that way is because the sponsors of those investments are trying to get somebody to sell their product. And they start at the top of Wall Street and they move their way all the way down to the bottom, which are these independent brokerage firms. And by the time they get there, they've increased the cost component to induce the brokerage firms to sell it, but they've then made it that much more difficult for them to be successful. And again, BDCs are structured very similarly, where you've got this enormous cost component. And if we've got a rising tide that lifts all boats, everything will be fine. But if the market moves against some of these companies, if, for example, we've got a slowdown in the U.S. economy, and we've got a raising interest rates, all things that could be happening this year, and it's now more difficult for smaller companies to borrow new money that they need to run operations, certainly something that could happen this year. If all of those things happen, these smaller companies who have raised money through BDCs are going to have a credit crunch. They're going to have problems, and they're going to have losses. And again, and it's because the BDCs are leveraged in order to get you that return, that 8% that they've sold you on. But if you're getting an 8% return after taking 10% off the table to pay all the financial advisors to sell it to you, they're doing it through enormous risk. They're doing it through leverage. And if they only have 10% equity in these things, and there's a 10% move in the underlying investments, that's where you get into problems. So, that's the reason I'm concerned for BDCs. And certainly if you've got a financial advisor who's recommending one to you, ask a lot of questions, make sure that you understand what you're getting. Unquestionably, if the market continues to hum along as it's been over the last few years, these products can probably be fine. And some of them, regardless of how the market performs, probably will be fine. But they're not all created equal. And certainly, if you're being told that it's a low risk environment or investment, I don't think that's accurate. Make sure to read the prospectus and the private placement memorandum that comes with the investment, because I suspect that's not what it's even going to say in the documents. That might just be what your financial advisor is telling you. But just be on the lookout for these products, because the information that's out there suggests that it's sort of the new product being sold by your independent brokerage firms. Again, it used to be non-traded REITs. Those are now harder sells because the clients who have been with independent broker dealers for the last 10 years have lost a lot of money on non-traded REITs. They don't want to buy them anymore. They have a bad taste in their mouths about them. So now you got to come at them with a new pitch. Hey, we've got this new product, completely different than non-traded REITs because it doesn't invest in real estate. These are small investments in, new companies that are going to be great. It's like venture capital, blah, blah, blah. But they are very similar to non-traded REITs. They do have the same risk component. They do have some of the same problems. So just be on the lookout for those. And specifically, some of the sponsors that are out there, because maybe your financial advisor doesn't even tell you that it is a BDC. So be on the lookout for the names. Here's some of the names that are out there. And again, I'm not aware of any current problems with these investments. Don't take it that way. But these are BDCs out there that are being sold by independent brokerage firms, and they would have some of those same elements that we talked about. BDC of America is one. AR Capital is one. Scion Investment Management BDC is one. Corporate Capital Trust BDC is one. Franklin Square BDC with acronyms such as FSIC1, FSIC2. I think they're up to FSIC4 now. HMS Income Fund, and Sierra Income Corporation BDCs. Those are just some of the sponsors out there selling BDCs right now. And again, they fundraise it through typically an independent brokerage firm, not a Morgan Stanley, not a Wells Fargo. I have friends who are financial advisors at those companies, and they've never heard of these things because at the high level of those companies, they were vetted and they said, no, we're not going to sell these things. So they go down the totem pole to your smaller firms that are willing to sell it because of the commissions that these products offer. And so, if you're at an independent firm, that's not necessarily good or bad. Some great financial advisors go independent because it's better for their business model. But those are the firms that would typically be selling these types of products. And if this is what you want, if you're willing to accept risk for 8%, that's fine. Just make sure you understand what you're getting. So that's the big tip for today is just be on the lookout for BDCs. Make sure you understand them if you're being offered one. We're going to take a commercial break.
Minuteman Press of Vero Beach, covering the Treasure Coast from Port St. Lucie to Sebastian, can handle all your printing and copying needs, from large format and blueprints to business cards and brochures, plus a full line of promotional products. Minuteman Press of Vero Beach. Google it.
Minuteman Press. Get a free quote. 567-4645. Minuteman Press is a member of the iTex trading community. Your iTex dollars are welcome.
You can trust Sandpiper Pest Control, serving Indian River, St. Lucie, and Brevard. Certified by the state of Florida to treat homes, lawns, and termites. Fully licensed and insured. Priced right, effective, and friendly.
Hi, this is Joel, the owner of Sandpiper Pest Control. Sandpiper can solve your pest issues. No contracts to sign, just results.
Call for a free estimate. 772-589-0204. Sandpiper Pest Control. A member of the iTex trading community. Your iTex dollars are welcome.
1-800-HI-MITCH. What's that number and who is Mitch? 1-800-HI-MITCH is the number for Mitch Maxfield's Carpet and Furniture Cleaning Services, serving Florida's treasure and Space Coast for over 30 years. And Mitch still does the work all himself. Call 1-800-HI-MITCH. Mitch Maxfield personally will clean your home or business. Call now for 2 rooms of carpet cleaning for $77 or a 6-foot sofa for $66. Maxfield Carpet Cleaning is a member of the iTex trading community and welcomes your iTex dollars. 1-800-HI-MITCH.
Welcome back, everyone. You're listening to Wall Street versus Main Street. I'm your host, Dax White. Before the break, we were talking about BDCs, or business development companies, and some of the concerns that I have with those products, including the high commissions, the risk, the illiquidity, the difficulty in valuing those investments, the likelihood that any of them will actually go public. Certainly there are some concerns with that investment in terms of it being sort of the next independent broker-dealer model after non-traded REITs that they would sell. There's actually a Wall Street Journal article coming out soon sort of on that same thesis. I'm not sure when it's going to publish, but I've been talking to the writer about it, and she sort of has that same general concern. So if you're interested in that, be on the lookout for that. The other thing that I wanted to touch on, we've only got about 2 minutes here, and I do talk about this maybe every week, certainly virtually every week, but I think it's perhaps the most important information that we can pass along. A lot of our clients could avoid being our clients if they better understood how to vet their financial advisor to make sure they're working with the right person. And the easiest way to do that is to go to finra.org, FINRA.org. And in the upper right-hand corner of that website is something called Broker Check. Type in your financial advisor's name there, and it will spit out a report called the FINRA Broker Check Report that will tell you everything you need to know about your financial advisor, including how they did on their licensing exams, where they've worked in the industry, how long they've been in the industry, whether they've ever been sued by a client, whether or not they've ever done anything criminally, whether they've declared bankruptcy, whether they've been fired by a brokerage firm, whether they've been investigated by a regulator. All of that information is on their broker report. And again, there's been so many times where we get a call and we tell the client, did you realize your financial advisor has been sued, 25 times? And they're horrified. They had no idea. And obviously, if they knew that at the beginning of the relationship, they probably wouldn't have gone with that person. And the other takeaway from that is that they're usually shocked that FINRA will allow a person who's been sued that many times to still be in the business. But I can tell you from my experience, if a financial advisor still makes their brokerage firm money when accounting for litigation, so if they make $100,000 a year for the firm, but they have to pay out $20,000 a year in claims because the guy gets sued every year, if those are the numbers, they're going to employ him. And it's very rare that a regulator would actually come in and kick somebody out of the business just because of customer complaints. So there are financial advisors out there right now who have been sued that many times. There's financial advisors out there right now who have been sued more than 25 times. I think the highest I've seen was like 72 customer complaints. I'd say that the average financial advisor only has 100 so clients. So that's a pretty high percentage of people who are unhappy with that person. But the point is that's somebody who is still in the business, still going. And so I think it is a poor assumption to assume that the industry will take care of this for you. Go to FINRA, check out your person on your own, and make sure you're working with the right person. If they've been sued one time, I would tell you that that's not unusual. And perhaps all you really need to do is just talk to your financial advisor about it, and they likely can explain away why that one customer was unhappy. But that's not indicative of a huge problem, at least not in my mind. But there might be some red flags there. And again, if you've got somebody who's been sued a bunch, that's a pretty big red flag. So check out your financial advisor, finra.org. If you want to check out the show more, we've got a bunch of research on our site, including how to find some of these regulators. Check us out at wallstreetvmainstreet.com and tune in next week. Thanks.
You've been listening to Wall Street versus Main Street. The views expressed by the participants of the program are their own and do not represent the views of, nor are they endorsed by, the White Law Group, its officers, directors, employees, agents, representatives, shareholders, nor any of its subsidiaries. None of the content should be considered legal advice. As always, consult a lawyer.